It doesn't take money to make money. It takes value creation, because money is just a exchange of value. And so if you know that you can create value, your income will be a byproduct of that. And by understanding you are your greatest asset, you'll be able to understand your human life value. All the things that make you are the source and creator of all your property value, your assets, your real estate, your stocks, your bonds, your whatever you want it to be. The more valuable you are, the greater property value you can get.
Money should be used for what we enjoy, not just to make 100,000 worth 150,000, or $1 million into 1.2 million. That ain't the goal, dude.
If you're just trying to stack $1 on top of another dollar, you don't need an advisor, you need a counselor.
Yeah, that's right, man. If you think that you're worried about turning $1 million into 1.1 in the next 12 months, and you're talking about all these investment strategies and you have no idea how to exit and how to spend the money, you don't need a financial advisor, you need a counselor, because your purpose is not understood. What's up, everybody? Welcome to another episode of Cash Flow Conversations. Today, I have an interesting guest. Don't let the baby face fool you. He actually knows what he's talking about. And he's proven that to me over the last few years. So I'm happy to have a very young, mature guest in Brock Fortner. Brock, it's good to have you here, dude.
Yeah, man. Thanks for bringing me up here.
Yeah, man. You've impressed me over the years with your youthful wisdom and mature cadence in the financial industry. You have a leg up, I think, because of some pedigree. You kind of grew up in the financial industry and learning all these mistakes at a young age. Talk to me a little. So today we're going to talk about financial planning for business owners, why a business owner should be doing something probably different than the employees, and how they have different options to invest in themselves. So before we dive into the fun stuff, give me some quick background on you. How did you get into the financial world, dude?
That's a good question. Like you, my dad was also in the business. But that wasn't the reason I think that I actually got into it. I was going to school to get an accounting degree, and then I realized I hated the accounting and never wanted to do a tax
accountant, though. I'm not gonna lie.
Yeah.
I can see you as hitting a calculator all day.
Absolutely. So I
You
hated
to be an
that.
accountant, and then you decided not to.
Yeah,
Not to. Why?
Yeah,
Why?
because I couldn't sit behind a desk all day. If you know me, you know I hate sitting inside and behind a desk, behind a computer. I would much rather be outside, playing golf, doing anything other than just sitting right here in front of the camera or a computer. So I went home and I was like, Dad, I can't do this. This ain't me. What am I looking into? And that's when my dad was like, hey, why don't you come to one of my workshops, see if you can check it out, see if you like it. And from then on, I was kind of like, all right, I know exactly what I want to do, and this is it.
Sweet, man. Yeah, your dad's got great workshops. The great Trent Fortner.
Yeah.
How many years does he have in the financial world?
I think he's got 36 or 37. He's an old guy.
Wow. Old guy. So you bring some youth to this whole thing, and we have a different delivery method because we can do these things called podcasts. So let's dive into some business owner stuff, dude. You've had a chance to work with employees, high income employees, low income business owners, and high income business owners. When we talk about business owners and employee retention, a common theme, you can drive by the golf course over by my house, Legends. They have a sign out front saying, we're now hiring and we give great benefits like a 401k.
Yeah.
And every time I drive by it, I'm like, man, there's so many other options than just a government sponsored qualified retirement plan. So, let's start there. Let's start talking about retirement accounts. As an employer, they can offer a lot of different benefits to employees. Talk to me about the 401.
401k is a great vehicle if you are cool with waiting for compound interest and maybe someday retiring. Like, it's great. It's, you can accumulate money in it and it's good. But like you said, there's a big difference between being the employee and being the employer. They both can run along the same path, but sometimes I think what we talked about this a couple days ago is like most people are okay with the fact of just handing their money over to somebody else and just putting the blame and trust in somebody else's hands so that if it does crash and burn, then you can just say, you know what? Sorry, it wasn't my fault. It was the market downturned, or, we're just part of the economy and that's just how it worked. When, you could take charge of your own finances and build an incredible legacy and, invest in what you know, understand, and have expertise in, and actually have a more fulfilling life.
Yeah. So for the employer, the one running the company, what kind of options do they have for themselves?
I mean, they have everything. And I think one of the things that we have to start with is a basis for how we create wealth. And once you understand that um, your human life value is the source and creator of all your property value, you as an entrepreneur have everything at your fingertips to realize, hey, if I want to create wealth, I just need to go create value. And if I can create value, my income will be a byproduct of that, which means more assets, more property value, more everything.
You said something you glazed over in the beginning, which I've been talking about a lot lately. The idea of creating value.
Yeah.
What? Say that line again.
So,
As a business owner, their ability to create value.
yeah. So, first, you want to understand that it doesn't take money to make money. It takes value creation because money is a exchange of value. And so, if you know that you can create value, your income will be a byproduct of that. And by understanding you are your greatest asset, you'll be able to understand your human life value, all the things that make you you are the source and creator of all your property value, your assets, your real estate, your stocks, your bonds, your whatever you want it to be. The more valuable you are, the greater property value you can get.
Right. So as a business owner, their highest and greatest rate of return is probably going to be in their business. So what I don't
100%.
understand is so many business owners then invest their money in other people's businesses in the form of stocks, bonds, and Wall Street. Like I see that's a huge conflict of interest. What do you
I,
think?
I think it is a big conflict of interest, but I think it's coming from the fact that we've always just been indoctrinated on the fact of, oh, if you want to invest, it goes to the stock market. Like that's if you ask anybody, oh, will you invest? They're going to say, yeah, I put money in my retirement account or a brokerage account. It's kind of like, okay, well, there's like millions of other things that you can invest in, and maybe the first place being yourself. And business owners are still tied to this whole fact of, oh, well, I'm just going to retire one day. Someday, I'll be able to retire on this big nest egg. Well, you know, most business owners that I meet when they retire, they end up coming back to work because they didn't like retirement. And so, what if we could start talking to those younger business owners and start talking to them about the fact, like, hey, like, what if we started teaching you how to retire in your business and have a more purpose filled life where you don't ever have to think about, oh man, I got to retire. I want to retire one day because I can get out of this crap. No, like, let's build a life you love right now so that you don't want to retire from it.
Yeah, 100%. I think a business owner too, we're kind of cut from a different cloth where the idea of sitting around doing nothing at 65 probably isn't the goal. At the end of the day, the goal is like, how do you create fulfillment for the rest of your life? And so, what are some methods of doing this? Like you believe the same thing that I do. The value of life insurance for a business owner because they have first they take care of their family. Second, they have access to capital in any economy, and they can use that capital for their business, for payroll, for hiring new employees, for marketing dollars. They can do anything. There's no question, and there's guaranteed growth inside the policy, even when the business owner is leveraging it for their own company.
Yep, absolutely.
So talk to me about that. Like the value of life insurance, I think is so misunderstood. Let me say one more thing though, because I think a lot of business owners are turned off by the financial industry in general because they know they can make a lot of money. Why would they just go park their money with somebody else? And the financial industry has done you got to give them credit, dude. The industry has done such a good job to make you think that you're supposed to go invest in the market to succeed. Uh, and then they're going to charge you a fee regardless of the performance. Like that's
Yeah,
crazy.
I I also think it's crazy, mainly from the fact of they're going to want most of the financial advisors, the people that peddle the stock market, are touting, oh, just if you just put it in here, you'll average 7% in compound interest. You'll be a millionaire by the time you retire, if it works out the way that it's supposed to, right? But then if you looked
Yeah.
at, yeah, if you looked at this, our buddy Garrett talked about this the other day. He was like, dude, I wish I could sell 401ks and not know what I know. Because if all you did was acquire all these 401ks, millions of dollars, I'll get to collect a fee on it every single year. And then when I'm done, I could just turn around and sell it for 12 to 15 times EBITDA. Well, dude, when you think of an actual financial advisor and the market, they are not concerned with how well your rate of return is doing in the market, what's going on. They're concerned with the money is in the account and it's staying in the account because they're worried about their
Yeah,
cash flow, not your cash flow. Because the longer it's in there,
yeah,
the more they're getting paid.
yeah.
And I think that's
And then
just,
think about the exit too. Like the exit is, let's say you make it to 65 and you retire. The industry, the financial industry, tells consumers that they shouldn't take out more than 4%, or else they're going to go broke.
yeah,
So think about that. If the fees, if your advisor is charging you 1% and you're going to live on 4, they're taking 25% of your revenue.
yeah,
The fee's not 1%. It's 25% of what you get to spend. So in other words, the advisor only needs 4 clients that look just like you in order to enjoy the same lifestyle that you've created. It took a lifetime to create it, and they just need 4 clients to enjoy the same.
yeah. I would say, once you understand the rules of financial institutions and banks and corporations, then you can really start to understand where things are going, right? Because they want money on a consistent, systematic basis, mortgages, 401k, IRAs, and then they want to hold on to it for as long as possible. Okay, penalties, taxes, don't touch it. We're going to wrap it around. And then when it comes to retirement, they want to hold on to it for as long as possible again and give you the smallest increments over the longest period of time. How do they do that? Oh,
Yeah.
Matt, just buy term insurance and invest the difference because you're not going to need your insurance when you get to retirement. But what that does is you cancel your insurance, you get to retirement, and now your assets that you are a millionaire on that's sitting in your 401k and your IRA and your brokerage account now are your income source and your life insurance. So what do? Well, you can't take really any of the money. You can only take 4%. So how many millions of dollars do you have to have the income that you want during retirement? It's a
A lot.
broken it's a broken, antiquated system that people continue to buy into because that's just all that they've known. Nobody ever questions what's going on. And we'll probably talk about this later, but you and I both talk a lot about life insurance, how to use it, why do we use it? And it's always funny to me when I get business owners, people that come in and they start asking all these questions. We spend 2, 3 meetings, even time after our meetings, answering all these questions and things that they want to understand. And at some point, I usually go, man, how many of these type of questions did you ask when you got into your SEP IRA? What about your 401k? Your brokerage account? Like, nobody asks these questions until you give them something that most people either don't understand and don't talk about a bunch, or people tell you that it's a bad idea. It's kind of like, well,
Yeah. I don't think I've met a business owner that knows what they're invested inside of their SEP IRA. They just know that their CPA says, I'm going to save you taxes, dump 50 grand into this thing, and they think they're getting a tax savings. And
yeah,
the advisor comes in with a parachute to save the day, saying, yeah, you're going to save all those taxes. By the way, let me manage all that pre-taxed money, and I'm going to charge you a fee on money that you're eventually going to have to give to the IRS. And if you don't give it to the IRS, your spouse will give it to the IRS as a single taxpayer when you're gone. And if she doesn't do it or he doesn't do it when they are gone, your kids have 10 years to get that account to zero. But don't worry about that now. I'm going to charge you a pre-taxed fee on pre-taxed money.
yeah, Matt, just look at the mountain chart. Look how amazing this is. It goes up every single year. But also make sure don't read the little small print in the bottom left hand corner because this only talks about without fees and taxes. Like,
Yeah.
I get business owners that come to me all the time that are either referred to me or they find me online or somewhere else. And we begin having this conversation about the fact of like, they're tired of those financial advisors giving them financial advice of just, oh, save 10, we'll chase 10%, and then we'll just wait 30 years. Nobody's in their corner telling them, hey, dude, you don't actually have to put money in the market. What if instead of putting 75 grand in your SEP, what if you just took it and purchased a coach? What if you invested in a coach? And if you asked any coach what the typical outcome is after somebody's invested in them would be in their income, more than likely, most of them would say they doubled their income. The greatest tax strategy in the world is more income. Well, with that more income, you could probably buy some other assets to offset all those taxes that you Didn't save because you didn't put the money in your SEP IRA, blah, blah, blah. Nobody's saving money, saving taxes by putting money in a retirement account.
And that's easy to prove. So you just said there's no saving money inside of a retirement account. It's easy to prove. Take it out. You've never taken receivership of that money. It's sitting inside of a pre-taxed account. There's no tax savings. Take the money out. Not only would you pay the tax, but you're probably going to pay a penalty.
Yeah.
So you have
But
less than you put in.
here's
There's
my
no tax
favorite
savings.
part.
If you want proof, ask a CPA to show you what tax bracket they're going to be in retirement. They can't do it.
Oh, but they'll say, Matt, you're going to be in a lower tax bracket when you retire. It's going to be all okay. Do you know what has
What
to
if Hunter
happen?
Biden's in office and he's got it? Go ahead.
I was going to say, what has to happen for you to have less, what has to happen for you to pay less taxes in retirement?
You have to be in a smaller income. You have to take less income than you're enjoying today.
And Matt, right now, like while you're working, what's probably the most expensive day of the week for you?
I don't know what.
Probably Saturday when you're not
Oh,
working
sure, yeah, right.
and you're doing fun
Yeah,
stuff.
when the kids want to go out and hang out. Yeah,
Exactly. I'm sorry, Matt. What day is every day in retirement?
Saturday.
Yeah. So just don't spend any of the money today. Let's just wait for 30 years and let compound interest do its thing. And then when you get there, sorry, we can't actually take all that money because we got to make sure it lasts.
And that's what clients tell me, that my CPA said not to take too much out because it's going to bump me into another tax bracket.
Yeah.
Well, when do you want to figure that out? When you're 45 or when you're 65?
Yeah. Or 25, maybe 35. You need time before 65.
Anytime before 65. Heck, 59 is a good time to figure that out.
Yeah.
So then how can life insurance be the savior? Because you can't deduct the money going into a policy. So
Yeah.
where are the tax savings?
Well, I'm not too concerned about the tax savings, Matt, to be honest with you, when it comes to the life insurance. It's great tax vehicle because it's going to grow tax free or tax deferred, but you can build it in a way that it's always going to be tax free, and then you can access it tax free. And if you understand by having life insurance is kind of like the heart of your financial model, well, you know that if you pump money into your heart, you're going to be able to move it out and buy other assets. Well, by doing this, now you're buying assets. You got life insurance, and it just so happens to be permanent life insurance. So it's going to be there when you die, right? So now you have much greater options on how you spend all of these assets instead of just subjecting yourself to a safe withdrawal rate, which is like 3% right now.
Yeah, and there's no market volatility, no tax. So I like your analogy of pumping the heart of your business. So money's going into the policy, so the death benefit's there to take care of your family, but then that blood is coming right back out of the heart and going to do more things, and that can be involved in your business or not. It can be an outside business or an outside venture, like a 401 cottage instead of a 401k.
Yeah, absolutely. I mean, you could take 10 grand and put it in the market and get hopefully maybe 10%, or you could put it back in your business, that same 10 grand, and maybe get a return of, 100 grand. It's totally up to you. But by having this life insurance asset in your portfolio of where you hold majority of your capital, you're putting yourself in a position to where you never interrupt the compound growth of the money. And we can talk about compound growth here in a minute. But you're able to acquire other assets, have those cash flows fund the life insurance back. So you just continuously do it over and over and over again. And one day you're going to look up and you're going to say, oh my gosh, I have all this cash flow coming in, and I still have all of this money sitting in my bank or my life insurance and bank account.
Yeah, I love it. Did I ever tell you how I left the last agency that I was in?
No.
I was in this financial firm, and I like working with business owners because they think outside the box and they have faith in themselves, not faith in the S&P 500. They're involved in the S&Me 500. And so we were doing these really big cases with business owners, and one of the top asset manager in the firm came to me and said, Matt, these people need assets. They can't have all of their money in life insurance. Well, I said, I totally agree with you. I'm all about them going to get assets that they can enjoy and visit and see and touch, and with tax benefits rather than just waiting to pay the tax someday. He goes, yeah, but those assets, they need assets outside of the cash value. And I said, agreed. And they don't need to be managed by you. See, the financial industry tries to teach you that you have to have these assets inside the market, and that because that's how they make money. It's like a fitness coach saying you have to take my course in order to lose weight. No, you don't. There's a lot of ways to lose weight. Of course, the industry is going to teach you to do what they're getting paid to do. And I think that the independent free thinker business owner is looking for an excuse or looking for a permission to not do what they probably don't have a lot of faith in to begin with. Business owners are looking for permission to not just dump money in the market because that's all a financial planner knows how to tell them that how to, and that's how they get paid. And I was telling that story about like my firm was like, yeah, business owners, people need assets outside of life insurance. Yeah, and they don't have to be managed by you.
That's right. That's right. I think when it comes to financial advisors, there's always this competition between, oh, well, you got to retire one day. And so you need all these, the money in the market. Well, the reality is you don't actually have to have money in the market. It's just, that's just what the most common thing is. I could own a crap load of real estate, have a ton of cash flow coming off that, and I'd be fine. I could retire on that. Or I could start purchasing businesses. I could retire on that. I could put people in place to operate those. And then you know what? If it just gets really, really bad and I just hate it and I'm just too old to answer the phones and deal with people, well, guess what? I could sell it. So it's not that big of a deal if you just don't put money in the market and you save money and maybe got a meager 4%. And then when good opportunities came along and you had access to money, oh, wow, sure, I'll purchase one of those.
Yeah. Yeah. Dude, access to money is crucial. Remember the Capital One commercial, What's in Your Wallet?
Yep.
I can't tell you how many people I've met that have hundreds of thousands of equity inside of a home that's just sitting there, that have hundreds of thousands inside of qualified retirement accounts just sitting there, going up and down, doesn't compound. Remember, if your account could go backwards, it's not compounding, and almost no access to capital.
Wait a second, Matt, did you just say that if your account could go backwards, it's not compounding?
Yeah, in the long 30 years compounding and the market's going to do great. It doesn't compound. The year you go to retire, it could go down 25%.
Hmm.
It's not compounding. And that's the last thing a 65-year-old wants to go through.
Yeah. Yeah.
Call one and ask them if they like that idea. No, they don't. They hate it. And that's why financial institutions came up with widgets to sell to help people get out of that. And they're called annuities, and they can be a good thing and they can be a bad thing. And then you get Johnny Hotcock with an opinion out there that'll just be a keyboard warrior talking about how annuities are horrible because his second uncle's cousin had a bad experience. So don't ever buy an annuity and don't ever buy life insurance because my barber had an experience with someone that he used to cut their hair who was a teacher and did this and that. None of it makes any sense because it's all based on opinion. And a business owner knows they haven't followed the traditional structure to get to where they are. They're already looking outside the box like, I think I can do better than just working for someone making what they want to pay me. I think I can make more on my own. Well, why shouldn't your money back that up? What if you did fund an account to take care of your family if the business fails or if you fail, and then have access to capital to go make the business work? Now it's all on you to succeed. And if I don't do that, I put money into somebody else's hands like a financial planner. Now I'm expecting them to do it, and now I can place blame on them. And I've completely removed myself from the responsibility of financial success. And I think more than 50% of Americans actually like that idea because they don't know the first thing about how to take control over their life. That's why they hate the room that they're in. They hate the job. That's why they want to retire in the first place. They don't like it.
Thank you for kind of bleeping out your own word there. I know that stuff doesn't get under your skin at all. And I
It's
think,
annoying.
I think a lot of times, we do tout, the whole life insurance and why it's important to have and why it's so good to have as an asset class. But I think what, a lot of people misconstrued or take the wrong way is they think that, oh, well, Brock, Matt, you're just telling us to put all of our money in this one account. No, we're not telling you to put every single dollar you have in here, right? You need lifestyle expenses. You got to pay your taxes. You got to do these things. but you need somewhere that your money's going to reside before you go invest it somewhere else, right? And I
Yeah.
think you have to be very clear about the fact of like, am I an investor or am I just putting money in places and I'm just gambling? Because if you don't know how, and if you put your money somewhere and you don't know how it earns, you don't know how it can lose, and you don't know how to mitigate the risk,
And you don't know how to spend it. You don't know how the exit works.
you are absolutely 100% gambling and speculating because you don't know the rules of the game.
Yeah, you kind of brushed over, but you're speculating. You're not even
Yeah.
investing. You're speculating.
Yeah. And so that's what most people are. But as an entrepreneur, as an investor, those people that I mainly work with, you got to have a place to put your money. And you got to build this war chest up that's accessible. It's tax free on the growth. And when you want to access it, you want to have no risk of loss. And it's protected in different areas, like maybe from creditors.
Yeah, and depending on the state, life insurance does all that.
Yeah.
So life
And
insurance isn't the end all be all. It's just the holding place. How many times people say, I want to get rich. I want $1 million. I want to have 1 million by the time I'm 35. Okay, why? Where's it going to go? What's it going to do for you? What is that going to do to change your life? Right? Do you really want the $1 million, or do you want the freedom and the access to capital in any economy, regardless of what's going on, so that when you're ready and you're not asking dumb questions like, how do I become wealthy? When you're ready and you see an opportunity, you have dry powder sitting on the sideline that you can go put into the place that you want to actually get involved in.
yeah, I
Like, if you're
talked
asking
to,
the question of like, what do I invest in? You're not ready to invest.
yeah, yeah. You should always invest in yourself first because when you invest in yourself first, that will ultimately tell you where your dollars should go next.
Yeah.
And what you just said there is so true. Everybody's like, oh, well, I want to buy all this real estate and I want this amount of income by the time, this whatever. And I'm like, okay, well, what's next? Like, what do you plan on doing next? And they're like, oh, I don't know. I was like, have you ever met somebody who's actually been financially free? No. Well, luckily I have. And I've been fortunate enough to work with a bunch of those people. And I'm in mastermind groups and investment groups with people who actually are. And they're not 65, they're like 40 and 35 and, 45. Life doesn't really change much. It just becomes more purposeful, more intentional. They're doing things that they love with people that they love. They're giving back and they have a newfound passion and they get up and they're like excited for what they get to do all the time.
Yeah. That's life, dude. It's sad talking to a 60-year-old with millions that they've never used in an account they've never actually, pulled money out of, invested in things that they think they understand, but they still don't understand the exit. And they're talking about all of the things that they wanted to achieve, and they have no idea how to make it happen. That is what I call a floater, a very successful, in an enviable position with a bunch of money, but they're floating along in life.
Yeah.
They have no idea what their purpose is.
Yeah.
Rate of return and money is not the purpose. It'll be you'll. I talked to a guy a couple weeks ago. He's talking about bag. He's like, you're gonna put money in this bag, and then the bag's gonna get bigger, and then you're not gonna get any happier.
Yep.
Money should be used for what we enjoy, not just to make 100,000 worth 150,000, or 1 million into 1.2 million. That ain't the goal, dude.
Yeah. If you're just trying to stack $1 on top of another dollar, you don't need an advisor, you need a counselor. Isn't that what you said yesterday?
Yeah, that's right, man. If you think that you're worried about turning $1 million into 1.1 in the next 12 months, and you're talking about all these investment strategies, and you have no idea how to exit and how to spend the money, you don't need a financial advisor. You need a counselor
Yeah.
because your purpose is not understood.
Yeah. Yeah. So Matt, let's go a little bit deeper on the fact of like, all right, Matt, Brock, I'm bought in, I'm putting money in the whole life, but what do I need to understand? I still think, I'm still thinking about, well, I could put money in the market, I could put money in a retirement account, I could put money in the bank account. Well, let's back up and we'll address all those. If you put money in the bank account, it's kind of like renting and owning in this scenario. If you put money in the savings account, you're renting your home. Every time that you spend the money on something else, the bank quits paying you interest. So the money's gone forever. And you're no longer ever getting interest on that money. Whereas if you put it in the life insurance before you go somewhere else, you'd be all right because they're going to continue to pay the interest on it.
Yeah.
And then you look at, I read it somewhere the other day. Like, yeah, you could put money in your bank account, but it's going to collect more dust than it is interest. And I laughed and I'm like, that's actually probably pretty true because your money's
Yeah,
going
but
to.
Mark, high yield savings accounts right now are paying 5%.
Oh, do you know for how much longer?
Well, no, but it's 5 right
But
now.
yeah, I haven't met anybody who knows how much longer either. But I would much rather know for certain, for guarantee, that I'm going to have this money and it's going to earn a rate of return over the long period rather than just maybe for the next like 6 months or maybe
Yeah,
12 months,
yeah.
right? If we
Yeah,
go to this,
good.
I was going to say, if we go to the stock market, yeah, it's great. You could chase a high rate of return, but then you got to, if something else comes along, you got to make sure that, it's at the right time and you're not selling when things are crappy. And I hate to break it to you, but most great things that have great deals are when things are pretty crappy.
Hmm.
So wouldn't want to put money in there, and you always having to predict when's the best time to pull money out. And you know, I hate looking at my phone all the time. I always laugh at the people who are constantly looking at their tickers and talking about, oh, it's up today. Oh, it's down. Oh, it's up. I don't care.
Yeah, you
Like
know what the market is? It's different than it was yesterday. That's all it is.
exactly, exactly. And then if you put it in your retirement account, sure. If you use a self-directed IRA, you could use the money, but it all has to go back in there anyways. So one day
You
you're
said
going to have to pull it out and pay the taxes on it. If you, a lot of people, oh, I could borrow from my 401k. Yeah, sure. Do you actually know how that works? You can borrow up to like no more than 50, or you can borrow 50% from the account as long as it doesn't exceed 50 grand. Then you have to pay the money back. And then there's just like one little piece that nobody ever talks about. The money that you put in your 401k is pre-tax, right? So that when you pull the money out, you pay ordinary taxes on it. Yeah. Well, do you know what type of money you pay back those 401k loans with?
after tax.
After tax money, right? And so if you do that quite a bit because somebody told you it was a great idea, well, guess what? You're going to be paying double tax on a lot of money one day. But if you put the money in the,
Taxation.
yeah, sure. We all love taxes, right? And so why not pay them twice? If you put them
But
in
you know what,
in
Brock, you're skipping over this. People say, well, I'm just paying myself the interest. Do the math. You're paying two
yeah,
taxes. Do you think the interest is higher or lower than your tax bill?
yeah.
Z. Tax
And
bills.
do you think taxes are going up or down over the course of your lifetime?
Yeah, it's fake. It's such a passive. To me, it's a very unattractive way to view life. It's very unattractive.
It is.
It's passive. You're watching it and you're crossing your fingers, and then you get these keyboard warriors, which I guarantee we're going to get it on social media after this. Well, the market's done 12%. We did this mutual fund did 20 last year. Great. And I'm not saying it's not going to. I'm saying every single year it doesn't. You don't need to be a rocket science for that. Rocket scientist. A lady showed me her statement, and the statement said like a 14% rate of return, but she had the same amount of money that she had 2 years ago. Advisor got paid, client has the same amount of money, and it's the
Wait,
same
so
advisor who's saying
Matt,
don't. Go ahead.
are you saying that you could get a positive average rate of return and still have no more money than what you put in?
There's such a difference of average rate of return and actual rate of return. Well, the market's averaged 10%. Great. Until you need the money in a down year, and it didn't for you. And this is the
Yeah.
challenge with, people say, well, you're in it for the long run. Well, the long run runs out. So for a 25-year-old, cool. You're in it for the long run. Don't use your money. Let somebody else do it. Go to work, hate your life, and watch an account that could go up and could go down. And when it goes down, you say, don't worry, I'm not pulling it out yet. Because I don't want to say a loser, but you don't know how the world works. You know, Kiyosaki said it best, savers are losers.
Yeah. But
And
it's,
he meant losing because they're not creating their own lifestyle, not creating their own purpose and fulfilling
yeah,
their.
because he used it as a noun, not a verb. If you go back and read through it, he's like, hey, if all you do is just save money and that's all you do, because you're a noun in that sense, yeah. But if you're doing it as a verb because you're saving to then get into investments that you have an expertise in, you have a high knowledge in, and you can control, you have a high degree of control and you're not chasing returns, that's a lot different.
Yeah,
That's a verb.
yeah,
You're being an investor, not a gambler.
yeah, yeah.
And so for all the keyboard warriors out there, Matt, let me talk about the fact that most of the people that I work with, sure, I work with some W 2 employees. Like, I enjoy them. I love working on cash flow mapping and how that works.
Well, a lot of
But
W 2 people don't want to be W 2 forever.
No,
right?
they
Like,
don't.
so you don't want to be doing the W-2 stuff.
Exactly. So the people that I typically work with, they're collaborative. They want to work with me. They want to work with a team. They want to work with other people to grow their vision. They're intentional to say, hey, I know what I want. Now let's go get it. And they're thinkers. I don't have to be in their corner all the time saying, oh, well, let's be sure that we are dollar cost averaging in a 60-40 portfolio. And then, we'll review it once a year. And then if it comes out of balance, then we'll have to rebalance.
Yeah.
No, like they're on their own and they send me notes that says, hey, I think I'm going to invest in this real estate deal. Can we collaborate on it and talk it through and then uh, make a move on it? Absolutely. Let's do that. Let's come together. Let's talk about it. See where we can pull our liquidity to get in the investment, and then map our cash flows on how you're going to recapture all that.
Yeah. So we're not saying the market is a bad thing. It just shouldn't be the end all be all for everybody with all of their money.
Yeah, yeah.
Just
I think
buying and holding.
a good portion of one of the guys that I look up to, his name's Scott Ford. He has a really cool portfolio. It's called the All Seasons portfolio. But what he does is, it's a 50-50 based on Warren Buffett's teacher of saying, hey, you want 50% in bonds and 50% in stocks, right? Well, if you're looking at, and this is coming from Brock, the investor person now, if you look at bonds and being an investor, you as the average person are buying from a retail standpoint, okay? Which means you're getting crappy bonds and you can't buy them the way that institutional investors can buy them. That portion right there is why we buy our short-term and long-term capital bonds through life insurance. Our portion of our portfolio, the 50% that should be in bonds, we purchase through the life insurance because we're using mutual insurance companies who buy bonds at the institutional level that have premium dollars constantly coming in every single month, every single year, and they're buying these insane amounts of bonds. Then you look at, the growth side of it, 25%, 25%. If you looked at the actual math and like portfolios of like these larger family institutions like Tiger 21 and these banks, what you'll notice is these family offices, these billionaires, these people only have 5 to 10% of their entire portfolio in equities. But some people need the market and it's fine. You
Even
could have,
banks, right? Banks don't keep
yeah,
money in equities.
no, because they're moving money constantly. They have cash flow momentum. If you have 25% in stocks and equities, you can have 25% in alternatives, hard money lending, real estate, businesses, whatever it is. But then you can begin to understand how things work. You're flowing money, you're growing capital. You need it all. We're just not saying put it all in the market, nor put it
Yeah.
all in whole life.
Yeah. Yeah. Money in motion is key, like you said with the banks. You got to keep money moving.
Yeah. And that brings up a good point. Everybody's like, oh, well, what about inflation? I'm going to be losing to inflation. Well, think of inflation like a target. It's a whole lot harder to hit a moving target. And if you can move your money, you're gonna take care of inflation just fine.
I heard a good saying the other day. The guy was talking about if you want to be a billionaire, or excuse me, if you want to, he said, if you are a billionaire and you want to just keep your money, buy $1 billion worth of land. It'll rise with inflation. It's a hard asset. If you want to become a billionaire, buy $1 billion piece of land with debt and put the least amount of money in it. Put $1 million in. And what you're doing is shorting the American dollar. This is what I talk about in my book too. I never use a cool line like that, shorting the American dollar, which is totally true. You're expecting the value of the dollar to go down. So you're paying off debt with depreciating dollars, and your asset is going up in value with inflation. So now inflation is your friend.
Yep.
You want inflation to take place because the value of your paper dollar goes down every single year and the property value is going up.
Yep. Yeah.
Inflation isn't always bad. It's a horrible tax on the middle class who don't understand it. And all the Dave Ramseyites out there who are paying off their debt, they're taking their most valuable dollars today, paying off an asset that we hope likely is going to go up in value, creating debt equity that they don't even use. And they've lost out all that on the inflation because now their dollars that they're earning years down the road are worth less than they were when they put them into the house in the first place.
Yeah. Yeah.
Interesting. All right, so talk to me about lines of credit for a business owner. I'm sure a lot of business owners have lines of credit at the bank. Something else that's funny because debt equity is a real thing. Because if your income stops or a business owner has no low income, they can't go get a line of credit at the bank because they don't have any income to pay it off. They have to get approval. Life insurance, you don't need an application. It doesn't show up on your debt to income ratio. It doesn't show up on a credit report. It doesn't affect your credit score. It doesn't affect your ability to get a loan. You have access to capital in any economy, no questions asked. That continues the underlying asset, the life insurance, guaranteed to grow every single year, even while the money is outstanding in your business, and you don't even have a repayment plan to put the money back into the policy. What better line of credit could you even imagine? I mean, what other characteristics would somebody want?
That's a good question. When I think about lines of credits for business owners, that's that first standpoint of, man, you got to qualify for these lines of credits every single time, unless,
And they can still call the loan, by the way.
yeah, they can always call. But one of the things that a lot of people talk about, and I think it's becoming more mainstream now, is the revolving lines of credit. And so what banks want you to do is post collateral so that you can have a revolving line of credit so you can put money in, pull money out, and be able to use it. And it's like interest only a lot of times. Well, the hard part with that is different industries, the banks may charge you higher interest, may charge you lower interest. Um, if you bring them a project, they could be like, you know what? Probably not going to lend you money on this one. AKA, find me a bank that's going to lend you money to put money in the stock market or your retirement account. But could you find a bank that will finance a life insurance policy in that? No, it's crazy. And in real estate and other businesses, they'll do. That was a little sidetrack. But if you can show up to the bank with your whole life policy, you can also have that as an access of lines of credit. One of the things that we talk about a lot is, or business owners talk to me a lot, is, hey, I just moved too quickly. I can't utilize a policy because it takes forever, and I just moved too quickly. Okay, well, you can technically have checkbook access, right? If you have enough money in your cash value of your life insurance policy, you can collateralize it with a bank, and they'll give you lines of credit on that cash value to use, whether that's one policy or multiple policies. So if you could have 10 policies between you, your spouse, your kids, and you could have all of this money in here, then during good economic times, go collateralize all of those with one bank and get a line of credit on it so that you can use it anytime.
You know
And
what the
that's
big thing
quick.
here too that uh, Dave Ramsey and Dave Ramseyites out there hate debt, and Dave went broke because he was over leveraged. And what you're describing is not going into debt. You're solvent.
Mhm.
If the bank calls the line or the loan, it's backed by the collateral and the cash value. They call the loan. Here's the cash value. No harm, no foul. So there's a difference of going into debt for the sake of going into debt, and then there's the idea of using other people's money that's backed by collateral. It's guaranteed. You're
Yeah,
not in debt. You're solvent.
yeah, correct, correct. Because when you get over leveraged, that's like when you go to a bank or a hard money or somewhere and you put down 10%, but then 90% of it is loaned because you don't have the money. But if you have a line of credit, what that means is you have an asset that's caught 100,000, 200,000, 500,000, but you don't want to interrupt that asset's movement, the growth that it has. So they'll collateralize it and you get to go borrow the money and use it in something else. So if
Yeah,
something goes wrong, just say, hey, I'm not over leveraged. You can have the asset. We'll call it a day.
yeah, yeah. Brock, this has been really good, man. And you're working on an ebook right now, aren't you, for business owners to understand how to do all this?
It sounds like, Matt, yes, I am working on a ebook or a book or maybe a white paper talking about why business owners, why investors should have whole life insurance as their holding tank, their war chest for where they hold most of their capital.
I'm going to promote not a book, not a white paper, but an ebook, something easily downloadable for somebody with cool graphics. It's a white paper with graphics for entrepreneurs that want to take control over their money.
Yeah, you'll have to help me with those pictures, but we can do it.
Yeah, man, that's what software's for. We'll let AI do half of the design. I'm not a good designer, but I
That's right.
like life insurance.
That's right. Me too.
All right, brother. Any final thoughts here before we let you go?
No, buy as much whole life insurance as you possibly can and make sure you come to me when you do it.
What a great ending. Well, we'll put a link to your website in the description. So anybody listening, go to the description. It'll be a link to Brock's website. Probably have an ebook up there by the time this podcast goes live. So thanks again for being here, brother.
Yeah, man. Thank you. This was fun.